Beautiful trade for 2016. Why charitable donations should be your number one advising selling point. As a disclaimer or disclosure, I am not a financial advisor. I am a self employed day trader, and however, I do have a financial education. All investments are subject to risk and loss, and you would need to contact your tax advisor, accountant, and financial advisor in order to implement what I am talking about. And I'll get to the big idea of this presentation and why it is exciting and why it makes sense, essentially, to get involved with charitable donations. Of course, for philanthropy, but also the nature of the financial markets and the environment that we're going into 2016 and beyond. So, this is a win win trade for charity. There's nobody on God's green earth who does not want to give to charity. And when they can feel good about it and philanthropic and maximize their benefits, that's even better. So, an individual may trade their stock for a charitable remainder trust. What is a charitable remainder trust? Essentially, that is a grantor trust that is can be revocable, and in this case, irrevocable, in order to retain benefits for future income streams and also for lowering their estate tax and their taxable estate um, and getting immediate benefits for their lowering their income tax as well. So this offers a lot of flexibility. People can donate to any charity, the charity of their choice, of their dreams, and just pretty much any charity under the sun. The charitable remainder trust, like I said, in this case is an irrevocable grantor trust, which means that the person that is investing, the person that is your client, the individual is the one making the trust, and they're the ones that are executing the trust. This can be funded with a variable investment. It can be funded with a Fidelity mutual fund, for instance, or any of your watermarked mutual funds within your outfit. These can be advisor managed. So if you have your own separate accounts, you can manage the account for their charitable fund. And they can donate to the charity of their choice. So there's about a million nonprofit organizations out there that are basically philanthropic, that are doing things like donating blood, basically giving sponsored events for donating blood, running marathons, stuff like that for instance, Donate Health or excuse me, Donate Life, where their marathons and 5Ks and 10Ks give to what is essentially organ transplants and raises money for basically saving lives. So to get to the nitty gritty, basically, long story short, when you talk to your accountant or tax advisor, or when your client talks to their accountant, they're going to have to file for Form 8283, and I won't get into that. That's just basically just noteworthy. So, as an example, an individual has a taxable income of $93,000. That puts them, since 2015, basically in the 28% tax bracket. So basically, they're able to get tax benefits. So for every dollar that they invest and that they basically take out of their taxable income, they're basically making 40 cents. So that's a 40% return. So the CRT allows a $10,000 soupy stock trade to become $14,000 to their charity. So that's extremely exciting because basically they get a bump to um, to donate more. So there's immediate benefits to this trade. They of course lower their taxable estate. So if they have estate planning needs, obviously a lot of your clients will have estate planning needs. This is obviously something that you're probably already doing with trusts and estate planning. And they keep with the CRT, they keep a remaining interest. So essentially, that means that they're going to get basically interest per year, per annum, until the life of the trust, which is forever. So the target market obviously is going to be individuals and couples who have estate planning needs. So if they're making a combined income of $250,000 a year, or they're at least making a household income of, like I said, the case where they're making basically $90,000 a year, $93,000 a year. So now they're in a high enough tax bracket where it makes sense for them to get rid of what is their stock and investment, stock and mutual funds, and turn that into a greater sum for their charity of choice. Individuals who have too much stock are a really good target market, because a lot of times you get more than your fair share of stock, and the individual is really just is not in need of that dividend, and maybe it's a losing asset. It's not making money for them, and so the environment that we're in, which is essentially an enriched stock market and equities, there's really a lot of room for downside. There's a lot of downside risk, and if they're holding on to it, maybe they're holding on to it for tax benefits. So this is one of those reasons why they would make such a beautiful trade for 2016. So your executives, your clients who are executives are also a great target market for this. They may have restricted stock, and I'll get into that later, why that's basically an aggressive way to target them, an aggressive way to basically create a sales advisory plan or an advisory strategy. So some things that are noteworthy: the investor must file Form 1041 to report their annual interest. They file IRS Form 8283, like I said, and that's to claim their charitable income tax deduction. So that's basically just protocol. And this trade can also be done with real property. So anything that has to do with physical assets, they can do the same thing. So it's a great way to increase their liquidity, and also bump up their annual contribution amount to their charity of choice. This is also, of course, fundable with an investment product, which makes you, as the advisor, puts you in the driver's seat. And you, as the advisor, can also manage the money, which is also a great benefit for those that are money managers. This is highly strategic. So one of the most beneficial trades, I would say, in 2016, there's not going to be any better trade than this. I'm a professional day trader, and you look in equities and debt, and you look at basically what is real estate. Well, this is going to be your best bet for 2016 and beyond, just based on the financial markets. So the advisor's strategy. So as the advisor, you may target executives at local corporations. You may target executives who are movers and shakers. You might have clients like this already, and they're very strict in what they do. They're very stringent, and it's hard to get. They do things on a whim. So the thing that makes sense for them is that if they are at a company and it's going IPO, or it's a private company and it's going IPO, or is getting bought out, these executives or would-be executives hold what is known as restricted stock. So that means that stock is pretty much like an option or a warrant, and it's worthless unless the deal goes through and they stay with the company. And so this has been like stock options for executives, basically to stick with the company and to be basically one with the company. When they want to leave the company, however, and that restricted stock basically would go to zero. So you're able to alleviate a lot of that cognitive dissonance, you could say, and you could alleviate a lot of that tension by turning that restricted stock into um, a prosperous donor advised fund, a prosperous trade. So if they plan on leaving the company before the IPO, if they plan on leaving the company before the target, the acquiring company finishes their acquisition, then you're doing them a great favor. You're alleviating a lot of stock, which is lame for them to sit on, and especially when it's restricted stock. So that basically example of $100,000 in restricted stock, which is not far too far to imagine. It, it, it instead of it becoming $0, it becomes $140,000 in trust. So that's the big idea. So that's where you can get aggressive in your advisor strategy with your executive clients. So of course they have the great flexibility. They can donate to the charity that they wish, and basically that's what makes this trade the best trade for 2016, because you're talking about a rich environment for a lot of this action and IPO and M&A activity. And so there's going to be a lot of these cases where you're having a lot of people that are sitting on a lot of stock, and that's just not desirable, especially when the stock is not expected to go up any greater, and especially when you have executives that are looking to move and shake, go to different companies or start their own organizations, and you're basically giving them the financial advice that they need, and so you'll find out how generous they become. So that's what makes this a very aggressive advisor strategy. And like I said, with all of the factors combined,